Welcome to XM.com. You're watching today's market comment by Ref BoJ. I'm Cristina Marujos. The Bank of Japan announced an end to 8 years of negative interest rates and sharply scaled back its asset purchases after its policy meeting on Tuesday, in a move that had been well telegraphed in the run-up to the decision. Citing that its price stability target had come into sight, the bank raised its policy rate for the first time in 17 years. The targeting of the yield curve was abolished and ETF purchases were scrapped too. However, policymakers pledged to intervene should there be a rapid rise in long-term interest rates, suggesting the bank is not yet ready to completely abandon control over the 10-year yield. Hence, there is a sense that the Bank of Japan still has some doubts about the inflation outlook and the strength of the economy. Governor Ueda told reporters in his press conference that it's necessary to continue to maintain accommodative monetary conditions. The yen slumped against major currencies such as the US dollar, euro, and pound, tracking the plunge in the 10-year JGB yield, though it fared somewhat better against the antibodian pairs. The yen has now almost fully retraced its March gains. But there could be hope for the Japanese currency come the April meeting, when the Bank of Japan will update its forecasts based on the outcome of the spring wage negotiations. Another currency struggling on Tuesday is the Australian dollar. The Reserve Bank of Australia kept interest rates unchanged earlier today, but policymakers softened their tightening bias, with Governor Bullock saying that the risks to the outlook were finely balanced. The Aussie was last trading about 0.85% lower against its U.S. counterpart. The dollar was headed towards 2.5-week highs against the basket of currencies. The Federal Reserve will be the next central bank this week that meets on Wednesday, and there is some anxiety about the updated dot plot. Following a string of stronger-than-expected U.S. data, including on inflation, investors are worried that FOMC members will pencil in just 2 rate cuts this year compared to the current 3. The revived concerns about sticky inflation have also started to weigh on equity markets. The S&P 500 has been flat over the past week, while the Nasdaq has drifted somewhat lower, but both indices recorded solid gains on Monday amid a bounce back in tech stocks. This was today's market comment here at XM.com.